And on the topic of bottom line, let's talk about casino operations for risk management. First and foremost is that casinos know their math. These casinos hire teams and teams of mathematicians and statisticians to analyze new games and ensure that the house edge is within the ranges that they need. Now, obviously, they want to make sure that the house edge is positive, otherwise they would lose money. But at the same time, it can't be too large or else no one will play at the casino. Assuming operations are in order, the house can only lose if the gamblers are cheating or if the game has a major flaw. And all successful casinos carefully guard against both. Take, for example, a casino might switch from a single deck to a multi-deck in the middle of a blackjack game. They do this when they notice that an advantage player is reducing the house edge. They're also quick to notice because casinos use high-tech surveillance to monitor players constantly. They truly do have eyes in the sky. So what's the takeaway for traders? It's simple. Arm yourself with the right tools and the knowledge. Track what things you're doing correctly, and also track where you need to improve. That way you'll be able to make sure that you're not letting things get out of hand and you're focusing on your weakness. Just like casinos are audited regularly to ensure that their games are fair and profitable, traders can do regular audits of their trading strategies. This can be done in the way of journaling, which many successful traders do. Whether you're trading stocks, forex, commodities, or whatever it may be, keeping a journal of your trades can help you identify what's working and what's not. If you're not reviewing your plays and your portfolio, then you could be missing out on very actionable data. And you don't have to be a math whiz to do this either. But just like the casinos, know your numbers and play them wisely. This is where the 1 or 2% rule can come into play, where you only risk a certain percentage of your account on any single trade. And I didn't invent this rule, but it's one of many sensible strategies passed down to me that made perfect sense. Why size up when so many generations of traders before me warned against doing that exact same thing? Now, obviously, it's relative to everyone's account size, their risk tolerance, and other factors specific to the trader, but it all leads back to effective risk management, the same type that the casino has. With effective risk management in place, we can then focus on compounding our profits. Using trading profits to make more trades can lead to exponential growth and wealth over time. Now, don't get me wrong, it's important to realize gains, but too much reckless spending can hurt more than it helps. The best traders in the world aren't profitable due to massive wins occasionally, but rather consistent profits over time. Let's do some quick math to illustrate the power of compounding. $1,000 compounded daily at 3% for 365 days straight results in over $48 million. Pretty wild, right? The fact is that the average house edge at most casinos is only 2%. They don't operate on a huge edge, but they have consistency in their 2% edge, which over time secures billions of dollars in profit. Now, despite all of these similarities, there is one really big difference between casinos and traders. It involves being proactive versus reactive. Casinos are generally more proactive in their risk strategy than a retail trader is. A casino has systems in place, like rules, security, comps, and perks, that proactively allow them to keep the odds in their favor. Now, they are reactive day to day, meaning they do adjust their systems when they notice something is affecting their edge. A retail trader is generally more reactive to what's happening in the markets day to day, but lack the proactive risk management strategy that can ultimately determine their profitability. Casinos rely on a single gaming model for their profits. So why do the majority of new traders attempt to trade with multiple strategies? Too many traders flounder for years trying one thing after the other. They never really focus on one plan long enough to get great at it. Instead, they're just looking for instant gratification. And just like a casino doesn't bank on a single hand to make profits, a trader shouldn't rely on a single trade. Defined risk and a methodical approach can mimic the casino's business model for long-term success. It's also important not to get greedy. There was a casino called the Lucky Dragon that went out of business. A lot of the local casino regulars mentioned that it was because they were too greedy on comping their gamblers. In essence, they were being stingy on the hotel comps, the food comps, and other things that keeps players coming back to the casino. They were way too focused on making high margins instead of longevity. Similarly, I see too many traders trying to be Mr. Double Up. They're trying to grow too fast or make super high margins, and that inherently means more risk. And honestly, I do see why. It's super easy nowadays to look at the big wins of other traders on social media, but this can easily develop a bias and a false sense of what a successful day of day trading looks like. At the end of the day, the old saying on Wall Street referencing greed is that bulls make money, bears make money, and the pigs get slaughtered. Now let's talk about the importance of discipline and consistency. In casinos, discipline is institutionalized. There really is no room for improvisation. For example, in a game like blackjack, the dealer has no choices to make. They must hit on 16 and they have to stand on 17. This isn't just a rule, it's a fundamental component of the game's design that ensures the house edge. The discipline is so crucial that even a minor deviation could lead to a disciplinary action against the staff and could compromise the casino's earnings. And in trading, the need for discipline is just as strong, but often must be self-imposed, which can make it much more challenging. Unlike a casino dealer who has a boss to fire them when they break the rules, traders have the freedom to make many decisions, even dumb ones. When to enter or exit a trade, how much to invest, and whether to stick to their strategy or deviate based on emotional factors. All of this freedom makes discipline both more challenging and more crucial to develop. And development of discipline is what you need when things get tough. We've all been there. We've had a losing streak, and it can be psychologically draining. But with the practice of discipline, it makes it easier to trust your system and not make rash decisions based on short-term outcomes, like a losing streak. Anyone who's been around a while. One of the most common reasons that traders fail is a lack of discipline leading to impulsive decisions like over-leveraging, overtrading, or deviating from a winning strategy. Just like traders who can trade on margin, there are gamblers who get lines of credit, or like we see in the movies of degenerate gamblers, they can get staked by not so savory characters, and this is extremely dangerous territory as we all know. Reddit's Wall Street Bets is littered with these cautionary tales, some real and some obviously from some talented fiction writers. But the risk here is real. Where else can you lose your entire life savings in a matter of seconds? Two places, the casino and the stock market. When playing games of chance like casino gambling or options trading, there is a powerful psychological enemy working against you. It's your ego. Professional gamblers also know that ego playing is a dangerous game, and honestly, many fall victim to an inflated sense of skill that leads to overconfidence and bigger losses. This is equally true in options trading, and the number one reason traders overtrade, it's simply ego. How many of you have seen that infamous clip of poker pro Phil Hellmuth losing his cool in a high-stakes game against Daniel Negreanu? Hellmuth was visibly frustrated and his face flushed, his body language screaming tension. Every hand he was getting more and more tilted. It isn't just a lesson in poker, it's a lesson in emotional management. And honestly, one that's incredibly relevant to what we do as traders. Now let's draw some parallels. In options trading, just like in poker, you're going to face situations that test your emotional resilience. You might have a few trades go against you, or the market could make an unexpected move that throws your strategy out the window. These are the bad beats of our world. And just like in poker, how you handle these moments can be the difference between long-term success or failure. First and foremost, always make sure that you're well rested and in a good state of mind before making any trades. Your mental and emotional stability are your foundational assets. It's kind of like the armor that you wear into the battlefield of the market. When you're not in the right headspace, you're more likely to make rash decisions, fail to stick to your strategy, and end up making mistakes that can be super costly. Now, let's say you do find yourself getting emotionally invested or tilted, as they say in poker. It's crucial to have a short-term strategy to ground yourself, whether that's stepping away from your trading desk, taking some deep breaths, or even pulling up your trading journal to remind yourself of your long-term goals and past successes. These little actions can serve as your emotional circuit breakers, preventing you from making impulsive decisions that you'll regret later. But what if that short-term strategy just doesn't work? Well, that's where you need to know that it's time to take a break. Step away, go for a walk, hit the gym, do whatever you need to do to clear your head. The market is always going to be here when you get back, and you'll be in a much better position to tackle it with a clear mind. Rough patches are an inherent part of the game. Whether you're holding cards or trading options, you can never avoid these challenges entirely. It's learning how to handle them with emotional intelligence and strategic finesse. Now, when you think of overplaying in the casino, what comes to mind? Do you see an emotional, tired, and wide-eyed gambler that keeps pulling out money from his savings account? Or when overtrading in the markets, we usually picture the revenge trader with the hungry look on his face, starving to get back his recent losses. Both are crossing lines, sure, but here's the thing. What about the overtrading that is less extreme, yet still hazardous? What I'm talking about is when you take a few green trades early in the day, and then you get bored. You know the feeling, don't you? When your higher brain says stop, and your lizard brain compulsively wants to keep going and chasing those profits. Or maybe you're just chasing a feeling, or maybe it's the boredom where you just don't know what to do with the rest of your time and you want to stay in the mix of the market. Yes, this is, by my definition, overtrading. So what is overtrading exactly? To me, It's simply when you trade in excess of your strategy. It's a deviation from the plan, and it happens because of the paradox of winning. So what is the paradox of winning? Here's a simple way of explaining this paradox in casino terms. If a player wins on day 1, they're more emotionally driven to return to the casino on day 2 and keep gambling. Now, after another day or two, their luck probably has eventually ran out, and now they're losing, but they're fixated on getting back to the feeling that they had on day 1. So for some players, the worst thing that can happen in a casino isn't actually losing, it's winning. And it's the same thing for traders. We saw a lot of this in the last year. People got way too comfy with the quantitative easing that fueled the markets after the pandemic. Traders, especially all of the newer ones, developed very bad habits in a market that was largely, in a sense, much easier to succeed in. And too many gamblers are greedy and therefore unwilling to quit when they're ahead. They've tasted success that stemmed from luck, and they don't improve their strategy and overall game. Or, if they are compulsive gamblers, they are unable to quit while they are ahead. Combine chasing losses with making sucker bets, and the trader will only accelerate their losses. Once their rational thought has gone out the window, emotions have fully taken over. For pure greedy gamblers, their best chance to make a score at a casino or in the markets is a hit-and-run gambling session. The problem, of course, is that virtually everyone who does win then raises their goal and says, just $1,000 more. And more often than not, they lose all of their winnings. While the casino rules and odds are available to anyone who looks, most people choose to ignore that and pursue that elusive big win. The same goes for trading your strategy. If you know the rules and odds, then neglecting in pursuit of more, well, to me, that's simply addictive behavior. Both the stock market and casinos can foster addictive behavior. The excitement and adrenaline rush that comes from confronting uncertainty and risk, it's potent. And some people seem to be addicted to losing as well. It's absolutely sick to watch this happen. And sadly, I've seen it at both the casino and in the Discord rooms. And a good sign of whether you may be exhibiting too much addictive behavior is in overthinking. And I heard another story from a fellow Discord trader too. He was so absorbed in the markets, it was taking a toll on his marriage. When planning a family vacation to Florida with his wife and kids, he didn't think that he'd even be able to go. Because number one, he said that he knew he'd just be thinking about the markets the entire time. And then two, he wouldn't have the ability to trade while he was there. Horrible spot to be in, but very relatable to many. So to sum it up, there are many parallels between the casino world and the stock market, and both involve elements of chance. But with the right systems and disciplined approach, it is possible to generate consistent profits over time. Avoid superstitions and focus on sound risk management strategies. Don't chase the wins or the losses and stick to your trading plan. Just like casinos leverage math and statistics for an edge, use data, backtesting, and journaling to refine your trading strategy. With the proper mindset and emotional control, you can turn uncertainty into opportunity. Trading may seem like gambling to some, but armed with knowledge and wisdom, the odds can shift right in your favor.